Welcome to the monthly Truck Stop webinar. This is Tommy Ruke. These webinars will be presented every second Thursday of each month at 2 p.m. Eastern Daylight Savings Time. We want to start by talking about the advantages of being a member of the Motor Carrier Insurance Education Foundation. I had a number of questions this week concerning that, and the question is, is the fee worth the cost? The TRS website, Transportation Risk Specialist.com, gives details information about the benefits and fees. All the information and education are included in the membership fee for all members and their employees. If you're an agency or a company, you get one password for your fee, and you can let as many employees as you want to access the data. The membership advantages are a discount on the standalone presentations of $50 per presentation. Our fees right now for the basic training, the annual conference, and advanced underwriting is a $349 for members and $399 for non-members. These courses, the standalone presentations, will be filed for state CE credit, and there will be a slight additional cost for covering the cost of notifying the state that you attended those classes. We do it that way because there's a number of people who do not need CE, and we don't want to build in the cost of the class as if we're going to have to send CE to everybody, and it costs additional costs just to process the paperwork, and some states have some requirements of sending them notices. Another advantage of it is starting in July, there will be a no-cost monthly webinar addressing in-depth considerations for insuring motor carriers. Our webinars will be bundled into 4 hours of CE credit. If you need CE, then you can get your 4 hours by attending these live webinars, which will be presented. We're thinking now presenting them twice a month. In case you missed the first one, you can also take the second one. There's no additional cost for the information. However, again, if you want CE credit, there'll be a processing cost added to it, and it'll depend on the state. We're doing research right now to be able to give a chart of what each state's additional fees will be, depending on what the state fees are and the complications of sending the information to the state as it to verify that you attended the webinars, you got the 4-hour CE credits, and also obviously to send you a certificate that will verify that you got those credits. For you who are not a member, we look forward to you joining the membership. Today's truck stop, we're going to talk about the Uniform Carrier Registration enforcement and what it means to your motor carrier, their insurance, and you. I'm going to do this part. The second part of it is going to be reinsurance consideration presented by Pat Hunt, a long-time friend of ours and an expert in the areas of reinsuring, particularly reinsuring trucking risk. Let's start off talking about the Uniform Carrier Registration System. The ICC Termination Act of 1995 mandated the DOT to replace the motor carrier registration system from 3 to 1. Previously, they were required to have a federal DOT number for all interstate motor carriers that were for hire and private. It required a separate authority registration for carriers who were hauling processed goods in interstate commerce. And then each state also had some of their requirements for interstate carriers for proof of responsibility. The ICC Termination Act gave the DOT 2 years to finalize this one numbering system. As part of this act, by the way, was the doing away with the difference between common contract carrier and doing away with the difference between for hire and private. This is what precipitated the ISO to file the motor carriers form in anticipation of the completion of this process, just a note. Obviously, the federal government moved slowly, and they didn't meet that 2-year commitment. However, 10 years later, out of the blue, having no idea why it was happened, the Congress passed a safety lube, which is the completion of the Uniform Carrier Registration System. This was done in 2005. It started by replacing the single state registration system. That registration system only applied to for-hire motor carriers with MC numbers. The fee was paid to a state, and that state distributed those fees to other states, depending on how many units that for-hire motor carrier with MC number operated in each state. And the proof of financial responsibility was tied into the 91X filing that had to be provided to complete the use of their MC number. Now the Uniform Carrier Registration System. It applies to all motor carriers. For-hire carriers hauling processed goods interstate or foreign commerce, which has the MC number that we just discussed, as well as for-hire exempt haulers. For you who don't understand the difference of this, a lot of you have been in seminars I've done. The difference was when my father was hauling cucumbers, he was an exempt. He had to have a DOT number, but did not have to have an MC number and a 91X filing because those commodities were exempt from federal regulation to haul. Those were mainly, those commodities are mainly time-sensitive things, perishable goods, mainly products of the farm. When he was hauling the pickles that now are processed, he had to have an MC number, he had to have authority, and he had to have a 91X filing. Those are the differences in the exempt and non-exempt. But also the Uniform Carrier Registration System brings into the requirements of registration and fees private carriers involved in interstate commerce. That is the big new difference. The federal government definition of a commercial motor vehicle is any vehicle with 10,001 GVW. For you who aren't familiar with GVWs and size of vehicles, this is any vehicle with 6 tires, passenger tires. These are the dualies. They meet that requirement. It also applies to people hauling passengers who have more than 8 passengers, or are transporting more than 15 driver if they are hauling their own goods, or anyone who is required to, that is hauling items that are required to be placarded under the federal hazmat requirements. If you're using a commercial motor vehicle, no matter private or for hire, no matter what you're hauling, interstate commerce, you're required to have a federal DOT number. The Uniform Carrier Registration System had 2 elements. First off, to pay a fee. This fee was replacing the single state registration fee that was collected before. These fees started in September 2007, even though the single state registration system was terminated in January 1st, 2007. The proof of financial responsibility, though, was not done on a timely basis. The problem was that the states ran out of money. The money collected in this system, as well as the single state registration system, goes to the states to support the enforcement of the FMCSA regs and rules. So the committee who was putting the Uniform Carrier Registration System together said, well, we need the money. We're not going to deal with financial responsibility now. We need to replace the money now. So they just focused on the money and delayed the financial responsibility. The big difference in this is that the previous fees were paid by only interstate for-hire motor carriers with MC number, and they had proof of financial responsibility attached to their 91X filings. Now, all interstate motor carriers with or without MC number have to be a part of the system. The fees were set, but the financial responsibility was delayed because of what we talked about. When we look at the big picture, though, the fees collected were a little over $100 million. These were fees that went to the states for enforcement of these rules. In fact, I was doing a seminar a couple of years ago in North Carolina, and we had a DOT officer from the state of North Carolina as a part of the seminar. And that DOT officer was an employee of the state of North Carolina, but he was paid by the federal government out of these fees to enforce the regs and the rules. And each state has a quota of a number of enforcement activities to gain the access to these $100 million. However, the past $100 million was only paid by for-hire carriers with MC numbers, which had roughly 170,000 of those. Now, under the new system, anybody operating a commercial motor vehicle, private or for-hire, interstate or foreign commerce, there's about 700,000 with DOT numbers. Guess what? The funds didn't happen. First off, this started right when the economy went down. So instead of trucks having the number of units that the fees were based on, they did not have those number of units. They weren't operating anymore. So therefore, when the application came in and the fees were based on the number of units, they were short those. The other ones, the private carriers, did not comply. In fact, what the information from DOT is, they sent letters out to all the people with DOT numbers, and about 10% of them came back, addressee unknown. In other words, the fees didn't come in because the committee over-projected the number of units were being operated and the number of insurers that would comply. Then there was a move to increase fees because of the shortfall. However, the for-hire carrier says, we're paying our fees. We know how this is done. We always have. Don't increase our costs until you make everybody who's subject to this law pay their fair share. The original fee basis, as shown here, ran from $39 if you had 1 or 2 units up to $37,500 if you had over 1,000 units. After a year, those fees were adjusted, and they stayed the same until the fees you see on the next slide, which is now $76 up to $73,000, again, depending on the number of units. So as you see, the fees were double, and these fees we're showing here are 2012. The last information I have, they'll be the same fees for 2013. The fee payday is July 1st of each year. With that history set up, there was a notice sent out by the Commercial Vehicle Safety Alliance. These are an organization of state enforcement officers that give guidance to the enforcement of FMCSA regs and rules, the inspections and what to look for. And they're saying, starting this February 2013, that all enforcement of the UCR at roadside must be increased. What this meant is that the truckers or the motor carriers who's supposed to have a DOT number, who do not, will be pulled over and stopped, and the ones who have not paid the uniform carrier registration fee will be also stopped and fined and made to pay those fees. What does this mean to us in a practical matter? The for-hire motor carriers with MC numbers and DOT numbers, this is not much. They pay their fees. They're aware of this. They always have. In fact, the fees, if you believe the publicity, is slightly less than they were paying in the single state because of the spread of the dollars over a larger group. Who has not done is the private fleet. And what the private fleet who operates in interstate commerce, what the government is saying is get with it because we need the money. When we look at the private fleets, though, the larger ones, the people who haul 18-wheelers, they are used to this too. They're big and visible in the stop. But the ones that are under the radar screen are the ones who have units 10,000 GW, 6 wheels, interstate commerce, that are not big trucks. What are we talking about here? We're talking about plumbing companies. We're talking about trust companies. We're talking about farmers. We're talking about newspaper deliverers. We're talking about people who service vending machines with for crackers and cookies. We're talking about those kind of risks. If they have a 1-ton truck, a truck with 6 tires, a truck that's 10,001 GVW or larger, if they cross state lines and that truck has a business name on the side, they are subject to requiring to have a DOT number and pay a fee. Those are the ones that are being focused here. So the business using the smaller vehicles, not the 18-wheelers, private carriers hauling their own goods, they're the ones under the radar screen. They haven't been stopped, and the reason they haven't been stopped before is because there was no dollars consequences to it. Now they're dollars. So the new dollar implication gives incentive to stop these units and make them pay this. Now when stopped for not having a DOT number and not paying Uniform Carrier Registration System, they must now obtain a DOT number and pay the fee. And here's where this goes through the FMCSA regs. I project there are going to be more people who will have to have a DOT number as these businesses using smaller units are brought into the system. They will have to apply to be a DOT number. After they apply, they'll get a phone call from the DOT because they can't distinguish between the local cabinet company, the local trust company, the local farmer versus a true for-hire motor carrier with 18-wheelers. And after that phone call, they will be visited by a state enforcement officer within 12 months. That's the law. That's a part of the MAP 21 process that was passed in July of last year. During this visit, oh, that's bad. Sorry, guys, I lost the you clicked off the right-hand bar. You lost the slide. The webinar here. Anyway, during the visit, the FMCSA officer will ask for the information. The information concerning this risk will now be seen in SAFER. So we'll get additional underwriting information. And they'll be subject to the Compliance, Safety, and Accountability, CSA, and some of them will have the SMS scores. The smaller units probably will not have subject to the smaller risk probably won't have many interventions and many visits by FMCA's officers as far as roadside stop just because of getting under the radar screen. This is the fee schedule and the enforcement of the fees. Next, we move to financial responsibility. Currently, there are 3 levels of financial responsibility that have to be proved before they can operate. For-hire motor carriers holding processed goods in interstate commerce with a DOT number and MC number. They must have insurance coverage, and that insurance company must send the FMCSA a 91X filing. That 91X filing says that there's an MCS 90 attached to the insurance policy that the 91X filing was based. The MCS 90 was mandated by the Motor Carriers Act of 1980. It's not sent anywhere. It's attached to the policy. The difference is, again, a 91X is sent to the federal government to complete the usage of their MC number, where the MCS 90 is an endorsement to the policy. So who must comply with the Motor Carriers Act 1980? All for-hire motor carriers operating in interstate or foreign commerce. Motor carriers with MC numbers and 91Xs, again, that we talked about before, but also exempt haulers. In other words, when my father was hauling pickles, he had to have a 91X that had MCS 90. But when we were hauling cucumbers, he did not have to have a 91X, but he still had to have an MCS 90 attached to his policy. Also, all private carriers hauling hazardous material, hazardous substance, or hazardous waste, both for hire and private, must also have an MCS 90 attached to the policy. There are only 2 exceptions to these rules. Vehicles with less than 10,000 GVW, unless they're hauling poisonous gas or Class A and B explosives, do not have to conform with the Motor Carriers Act of 1980. Second is, if you're crossing state lines or not. If you're crossing state lines, any quantity, 1 lawnmower with gas in it would have to comply if that lawnmower was carried in a vehicle 10,000 GVW or larger. If you never leave state lines, then it would have to be in interstate commerce, or excuse me, intrastate commerce only. It'd have to be in bulk. For most commodities, bulk is defined as 10,000 pounds of a solid and 3,500 gallons of a liquid. I want to stop here and just explain there's a difference. These smaller commodities do not have to be placarded, yet they do require the increased financial responsibility limits, even though they don't fall under as a hazmat hauler per se that requires special driver screening, special driver qualifications, and having to be placarded. The fine for not complying is $11,000 a day. But how are these enforced? This is the big difference. Today, the only way it is enforced is when the DOT officer comes and visits and does a full compliance review at your insurance offices or the motor carrier's offices. These are businesses that have DOT numbers. They don't go to all truckers. They don't have 18-wheelers, and no one asks for MCS 90 to be added to the policy. With the new enforcement, you'll get that call. Agent gets calls and insurance says, there's an enforcement officer here and wants to see my MCS 90. What's going to happen here is now these new people who have not had DOT numbers before will have this visit, and that's going to be a question that you're going to have to answer, and you're going to be found that your insureds are going to have to be asked. Now, whose responsibility is to make sure you have an MCS 90? It is the motor carriers, the insurers. They have to ask for this endorsement to be added to the policy. Clearly, if dealing with true for-hire truckers, we all know that if we issue a 91X filing, then MCS 90 must be attached to the policy the filing is based on, because that's what the filing says. So we would not want to not comply with the wording on the filing itself. However, truckers without 91Xs, again, exempt haulers and private haulers of hazmat material in interstate commerce or in bulk in intrastate commerce also need an MCS 90. That's not sent anywhere. That's attached to the policy. And I would suggest that we only add that endorsement when the insured asks for it. So now, with the new increased enforcement of the UCR, driven by the additional dollars, the pressure on the businesses who are not true truckers to obtain a DOT number and pay the fee will be increased. And second, now with complying with FMC's rules and regs, this will be an increase of the need for MCS 90s attached to the policy. This is where we stand today. Now, something else has happened. On February 25th, 2013, there was a news report. For you that get my information I have been sending before that I've dubbed friends and colleagues, I wrote a memo November 30th, 2011 about this happening. And this is the completion of the Uniform Carrier Registration System. The FMCSA has sent this rule that I sent the information to everybody again on November 30th, 2011 to the Office of Management and Budget to complete the Uniform Registration System. The publicity says it takes about 3 months to do this. Projected date is the end of May to have this starting to enforce this stuff. Again, it could be delayed. The projection savings is some millions of dollars of paperwork because of duplication of paperwork and the simplicity of the system. There will be additional fee involved in this for the compliance here versus in addition to the uniform registration fees. Projection is it's going to save about $42 million in this process. Now, the completion of the Uniform Carrier Registration System. Here's what the law that was proposed in November 2011 said that was going to be a part of the finishing this. I have not seen and has been published exactly what was sent to the Office of Management and Budget, but the information I've read has pointed out these following things. The MC number will go away. The whole basis of identification will be just the DOT number. There'll be no longer any issuance of MC numbers. This will require the 91X filing to be modified by the words in it because it refers to authority that was tied to the MC number, and that will go away. So what is the form that will require the filing, I don't know. My projection is that there will no longer be any paper filings. It will all be done electronically. And in electronic filings, it will just refer to the law. It will not refer to any specific paper. However, here's the big kicker. Proof of financial responsibility will be required for all motor carriers who now are subject to Motor Carriers Act of 1980. So now, instead of having passive enforcement, meaning when the DOT officer comes knocks on the door and says, let me see your insurance, let me see if you have an MCS 90, which is not done often by many truckers. Now there'll be a positive. A trucker, again, for hire, MC number in the past, for hire hauling exempt commodities, cucumbers, as well as private carriers hauling hazardous material, interstate commerce, will have to have proof of financial responsibility sent to the federal government to complete their ability to operate in that arena. That's going to be the big kicker in this. More people will have to have a filing. Again, introducing for the first time private carriers having to have a filing. This is the big difference. They'll also have better tracking of the motor carrier brokerage and freight forwarders. There will be one application instead of two now with the MC, the 150 number, and the OP1 to get the MC number. It'll be one. Some of you in previous seminars have seen the MCSA-1, which is a projected new application, and it goes to about a 23-page application, is the one that I had reviewed. It also raises the bar to enter into the motor carrier business, in other words, to get a DOT number, trying to better track the chameleon trucker. Chameleon trucker is someone who had bad history and washed out that bad history by starting over again. For you who are not aware of this kind of operation, you might want to refer to a blog that we wrote, a white paper that we wrote a couple months ago that says, or a couple weeks ago, that says that this is not what you want to do. This is not a positive thing to do. You want to stay away from being a chameleon. Your insureds want to stay away from being a chameleon carrier by getting a new DOT number to wash out past history. So in conclusion of my part of the program, the Uniform Carrier Registration conclusion, most differences between for-hire and private carriers will go away for interstate motor carriers. Information about businesses will be in SAFER, which will have more information about more businesses because of the requirement of the DOT number. Proof of financial responsibility sent to the Federal Motor Carrier Safety Administration. Anyone requiring to have an MCS 90 will now have to have a filing. And there'll be better control of people who are granted permission to operate. That's a good thing. It'll help weed out some of these bad actors in this area. Anyway, this is what I see happening here, and for your information to give to your insureds, they would be surely interested in this. Again, the ones that I would think that would need to have more emphasis paid are the ones who are not true truckers, the ones who don't have 18-wheelers, but the smaller risk. Now with that, I'll turn over the rest of this program over to Pat. Pat, are you there?
Thank you, Tommy. It's nice to speak with everyone today. I want to talk about reinsurance. There are a lot of questions on reinsurance and what's happening in the market. I'd like to start with giving a little background. There are basically two types of reinsurance. Individual risk transactions, facultative, where the reinsurer and the insurance carrier negotiate coverage, limits, and premium on an individual account basis. And then there's portfolio reinsurance or treaty reinsurance, where an entire book of business on commercial trucking, commercial automobile is negotiated, and a lot of data is gone over to provide the coverage on the whole portfolio of business. And, you know, this has been around since the beginning of transportation, with Lloyd's of London in the 1600s insuring cargo ships. Transportation and reinsurance have had a long, long history together, and it's changed over the years. There are two basic structures for reinsurance, whether it's individual risk or it's portfolio. One is a quota share, or percentage of the limits being offered from the first dollar of coverage. If you have $1 million policy limit, sometimes there's a 50-50 quota share, where the reinsurer takes $500,000 and the issuing carrier takes $500,000. They share, each party shares in the premiums and losses from the first dollar of coverage. It's fairly straightforward, and it's easier to calculate the premiums. Excess of loss is where the reinsurer provides coverage in excess of a specified limit. Again, for the $1 million policy limit, the reinsurer could provide $500,000 excess of $500,000. The first $500,000 being retained by the insurance carrier. We're going to be having a white paper coming up soon on reinsurance, and we'll go through a lot of these issues and any questions that will come up in the interim. The current market for trucking in reinsurance basically is an excess of loss basis. Retentions by issuing carriers have been increasing. The market interest on a quota share is really not there very much. The reason for this is experience. Reinsurers have in the past been involved where the losses have grown considerably, and they believe that if the issuing carrier has a greater interest in the business being written, then there will be more adherence to guidelines and pricing determination. There have been issues where fronting, where there's no interest being retained by the issuing carrier, had been a part of the marketplace. I do not currently see that as a truly viable alternative. There may be some unique situations. Alternative risk, captives or risk retention groups certainly are an option. Here you need to have a well-funded program with all the participants contributing to the financial security of the program. The question is, what are the financial incentives for the insureds or members of the captive or risk retention group? Let's see how we go. Here we go. What do reinsurers want? There's the big question for everybody. And I went through what I had been looking at for reinsuring trucking programs. And here's some of the basic things we look for. Well, the basic exposures. What kind of trucks hauling what type of goods? Are we talking 18-wheelers? Are we talking long haul, regional, local? What are the exposures that are there? What kind of drivers? You know, do they have clean MVRs? What's the insured's process for screening and monitoring their drivers? Geographic distribution. Where are the vehicles located? Are they in major metropolitan areas? Do they have a lot of left turns, which can be problematic? Do they travel long distances? What kinds of logbooks are being maintained? Again, having historical data on experience by type of exposure and where those trucks are located, reinsurers come up with what they believe to be the appropriate premium, which we'll get into in just a second. Current rates, primary rates. What are they charging per vehicle? And what have they been charging for each of the past 5 years? You know, as we all know, rates go up and rates go down. And in many areas now, they're going up, not solely due to the experience of the commercial auto exposure, but overall exposures and historic losses in all lines of business. Claims history. Claims is critical, as is, you know, all the previous information on exposures and pricing. What does this information tell us? You know, how do we know that this is going to be a profitable book? Has it been profitable in the past? If not, why? Is there something that can be seen that caused the losses, or a subsegment of the commercial trucking exposure that resulted in more occurrences? Is there a way to control that through loss control or risk selection? Reinsurers do look at that quite a bit. The actuaries look at the development triangles. Auto liability has a shorter tail than general liability, so you do know a little sooner how the portfolio is doing. Underwriting competence is a really big part of this. You know, you can have the best pricing, best handling of claims, but if the underwriters don't understand what they're doing, it'll fall apart. On the other hand, you can have a great underwriting guideline, top-notch pricing, but if you can't sell it to the insureds, what good is it? So we need a group of expert, consistent underwriters to provide the best key to success. And that's where this organization comes in, helping people to achieve that expertise. Underwriting audits. Reinsurers and their representatives go out and do an awful lot of underwriting audits. And what we looked at is the entire file, the underwriting thought process, the guidelines, were the accounts being written in adherence with the guidelines, were the drivers being underwritten, were all the details there, were the quoted coverage terms evident in the policies issued, and did the thought process and judgment of the primary risk taker show a knowledge, understanding, and expertise. I can't tell you enough how that can make a difference. Sometimes a reinsurer will look at spreadsheets and loss triangles, but then we'll go and discuss with underwriters and underwriting management and managing general agencies, and then get a true understanding of how the business is being put on the books. Financial, putting all of this together, you know, are we able to make money? Will the portfolio be profitable? All parties need to be profitable, particularly those in the risk sharing. So if they're not profitable, and if there are changes that cannot be made to make it profitable, then the reinsurer is probably not going to be interested. So it's understanding what the exposure is, how it's being underwritten, and what can be done. If it is profitable, great. You know, let's continue with the same thing. Let's look at the pricing. Let's look at the rate level being offered. Are there changes needed? There is a reinsurance market today for long-haul trucking. Not all reinsurers have an appetite for it. But those that have worked with the exposures over the long term and partnered with experts know that they can make a profit and continue to be a viable resource. It's very important that everyone understands the technical issues behind trucking and that they can understand those aspects of trucking, they can price appropriately, and that the claims can be handled cleanly, clearly, and quickly so that the expense levels won't continue on unending. You know, the transportation industry is not going to go away. It's not going to get smaller. And we need the tools to be able to represent those exposures more clearly to our insurance partners. And this is what all of this is about at this time.
Pat, thank you for that brief review of reinsurance. As the market tightens and prices going up, there will be a lot of risk, or a lot of agencies, a lot of opportunities to have some retention groups and have some other kind of mechanisms, and reinsurance is a big part of that. To wrap it up, for you who aren't familiar with a lot of this, the TSR Live Seminar starting in April of next year, or this year, will address this stuff in more depth. Annual conference will have representatives from the Uniform Carrier Registration System to update these latest things. If you're not a member of the Motor Carriers Insurance Education Foundation, we hope that you will consider membership. We hope you'll see the benefit of it behind the fee for the CE and the increased knowledge. This week I've answered some questions concerning the MCS 90, some things we went over today. Just this morning I worked with a wholesaler concerning a book of business they had and the need for a 91X and MCS 90. We'll have another seminar starting at 2 o'clock Eastern Daylight Time on April the 11th, and again it will be open to the public. If you all have any questions that you need to be addressed, you can go on the website and use Ask Tommy, and we'll be more than willing to answer those questions and send them back to you. We appreciate your time and spending your time today. We hope you got something out of this 45 minutes or so that we spent together. For you to help us develop these monthly webinars, please also send us any subjects that you think you would want us to address in this time frame so that we can develop them and send them to you. We will send out 2 weeks before the April 11th date the subject matters that we'll be addressing on that particular date. This particular webinar, as all of our webinars, will be preserved on our member website, which right now everybody has access to if you want to download it and print it or listen to it for more detail. Again, we thank you for your interest and attention in the Motor Carriers Insurance Education Foundation and the TRS program. This is something new. This is something that I have been doing for a long time, and we're trying to share this information with you now. Just this example of the Uniform Carrier Registration System being finished, where we let our people know about it last November 2011, and later it comes to some fruition. These are the lead times that we try to give you on these things that are happening and how the government taking these steps will affect us in the long term. Again, thank you for your support and interest. We look forward to hearing from you and also for participating in our program. Thank you very much. I'm over and out.